Good afternoon, everyone, and welcome to this webinar on the Corporate Sustainability Reporting Directive. Today we will talk about what the directive entails, who is affected by it, what the reporting obligations are, and how companies can prepare to compliance. The aim is to help you understand not only the new rules, but also the opportunity that might arise from increased transparency in the ESG area. So let's start with the basic. What is the CSRD? It is a European directive that came into force in January 2023 and imposes new sustainability reporting requirements. This legislation has a huge impact because it introduced common standards for 1,000 companies, obliging them to publicly disclose detailed information on the environment, social, and governance impact. A key aspect of the Corporate Sustainability Reporting Directive is the adoption of the ESRS, that is the European Sustainability Reporting Standards, which defines which data must be reported and how. In addition, the Corporate Sustainability Reporting Directive introduced the principle of dual materiality, which we will see in a moment. Okay, so what is the role of ESRS? To comply with the Corporate Sustainability Reporting Directive, company must follow the ESRS, which clearly define what must be communicated. There are 12 standards covering general, environmental, social, and governance aspects. Thanks to these standards, information will be more transparent and comparable between different companies, allowing investors and general stakeholders to make more informed decisions. Going into more details, the 12 ESRS standards are divided into ES1 and 2, that is covering the general and general reporting requirements, and the ESRS E1 to E5, focusing on environment, emission, natural resources, biodiversity, and ESRS S1 to S4, relating to social impact, human rights, working condition, inclusion. And finally, there is ESRS G1, concerning governance, so transparency, risks, ethical policy practices, and so these are the 12 standards. Now moving more to the other important relevant topic. So what is the double materiality? Double materiality is a distinct element of the Corporate Sustainability Reporting Directive. And this means that company must not only assess how ESG factors affect their business, so financial materiality, but also how business affect the environment and society. So that is the impact materiality. The financial materiality, so focusing on how sustainability-related risk and opportunities impact the company financial performance. So investors and stakeholders need to understand how ESG factors influence profitability, risk exposure, and long-term reliance. While impact materiality instead shifts the perspective outward. So how the company itself affect people, the environment, and society. It considers social and environmental consequences across the entire value chain. So, going to another key element of this directive is, sorry, just going back 1 second to again to the double materiality. I want to say that in summary, double materiality ensures that sustainability reporting is not just about financial consequences, but about how companies are acting responsibly. So in general, it's a game changer in how business approach ESG. To give an example, a company in the general sector must report not only how climate change might impact its operation and cost, but also how its CO2 emission contribute to climate change. And this approach allows a more comprehensive and responsible view of what the company is actually doing. Moving forward to the another key element, a key difference from of this directive. So it's mainly comparing this directive with the previous one, that is the non-financial reporting directive. So the main elements are we can say is the extended reporting requirements, so including more companies. So it's mainly moving, now there are only around 12,000 companies, and it's probably there will be around 50,000 company. Another key element is the standardizations, so with the ESRS. Another key element is the third-party assurance. There will be a subject, an external subject that needs to verify, and so be a kind of guaranteed of what actually is presented in our sustainability reporting, which was not the case before. And finally, there is also a part of digital reporting. So it uses a digital formats that can be easy access also for for the European Commission and for the analysis of what has been reported. So also this part of the digital reporting is also very important. So also moving forward to the next slide, which will be also my last slides. So, and then I will leave the floor to Denise. So the key objective of the Corporate Sustainability Reporting Directive, it's important to understand why the EU actually introduced this directive. So the main objective of the Corporate Sustainability Reporting Directive is to expand and standardize the disclosure of material sustainability information for companies operating in the EU. And the main goals are improve stakeholders and investor access to sustainability data, ensuring the sustainability information is accessible and useful, enhance investor decision making, so investor can better assess financial risks and opportunity related to sustainability. It enables also consumer to make more informed decision, since consumer can evaluate a company's sustainability performance much better than before, and encourage company to improve ESG performance. So from climate impact to employee safety. So the Corporate Sustainability Reporting Directive pushes company to track and improve their sustainability performance in general. So this directive ensures that sustainability reporting is not just formally, but actually is a tool for corporate improvement and market transparency. So this is a little bit everything on my side. So I leave the floor to Denise, who will present this next slide.
Thank you, Francesco, and good afternoon, everyone. Okay. I have the control of the presentation. No. Okay, yes, perfect. So now we are going to see who is impacted by this directive. And as we have already mentioned, the CSRD has a global impact and significantly expands the number of companies that must comply. In fact, the number has grown from around 11,000 under the NFRD to approximately 50,000 under the CSRD. And in summary, it applies to all large European companies, both listed and unlisted, small also to small medium enterprises listed on EU markets, though with simplified requirements for those companies, but also to non-European EU companies with a significant presence in Europe. And this means even companies that are outside the EU will be affected by the directive if they have strong business ties to the European market. But let's now take a closer look at the companies that fall under the CSRD scope. So first of all, the companies already covered by the non-financial reporting directive. So companies that were already reporting under the NFRD must now transition to the CSRD framework. And these companies are mainly large publicly listed companies with over 500 employees. But also to large EU companies, even if not listed. So a company must comply with the CSRD if it meets at least two of these three conditions, that is more than 250 employees, a net turnover above 50 million, and the balance sheet total above 25 million. This means that many private companies, even if they are not listed on the stock exchange, must now report their ESG, environmental, social, and governance data. And then there are the listed small medium enterprises on the EU regulated market must comply with the directive, although they have simplified reporting requirements, as I said, compared to to larger corporations. They meet the criteria if they have at least two of the following conditions. As you can see, more than 50 employees, a balance sheet total above 5 million, and a net turnover above 10 million. It is important to note here that not listed small medium enterprises are not required to report under the CSRD unless they are part of a larger corporate group that is required to comply. And finally, there are the non-EU companies with a significant EU presence. So even companies based outside the EU, as we said, must comply if they do business in Europe and meet certain criteria, such as a net turnover above 150 million in the EU for 2 consecutive years, plus at least one of the following conditions, which are owns a subsidiary in the EU that qualifies as a large company, owns a listed subsidiary in the EU, and finally has an EU branch with net turnover above 40 million. Then also the deadlines depends on the size of the company. In fact, by 2025, there are the large companies already subjected to the NFRD. Then by 2026, the other large companies, 2027, the listed small medium enterprises, and finally by 2029, there are the non-EU companies with subsidiaries in Europe. All of them have to report on the previous financial year. So, for example, the first one has the first group of companies has to report on 2024 financial year, and so on. Now let's focus on what companies actually need to report under the CSRD. In fact, the directive introduces detailed disclosure requirements covering both financial and non-financial information. This ensures that businesses provide a complete picture of their sustainability risks, impacts, and also opportunities. For the financial disclosure, it focuses on how sustainability factors affect a company's financial performance and position. And companies must report on traditional financial statements, including key metrics related to profitability, assets, and liabilities, but also on impact of sustainability risks, so how climate change, resource scarcity, and regulatory shifts affect the financial stability. And finally, on quantified ESG financial implications. So companies need to monetize the risks and opportunities associated with sustainability issues. Regarding the non-financial information, this part covers ESG-related data, ensuring that companies go beyond financial and beyond financials and disclose their impact on people, the environment, and governance. This double level of disclosure is crucial to ensure transparency and help stakeholders assess the companies more comprehensively. But going more Okay. Going more specifically, the CSRD requires companies to provide information on four general macro areas. The governance, where the company must explain how sustainability decisions are made at the board and management level. Then strategy and business model. It must be clear how sustainability is integrated into business strategies. For example, if a company has targets to reduce CO2 emissions, it must indicate how it intends to achieve this goal. Then impact risks and opportunities. Here, the ESG risks to which the company is exposed and opportunities arising from a sustainable strategy are described. And finally, the metrics and targets. Here, companies must state their sustainability targets and the KPIs used to measure progresses. We can say that regarding this part, the companies must follow the European Sustainability Reporting Standards, ESRS 1 and 2. Regarding the ESRS 1, the general requirements, it defines how companies should structure their sustainability reports and also includes principles, methodologies, and reporting frameworks. As for the ESRS 2, general disclosures, it covers mandatory disclosures for all companies and also requires transparency on stakeholder engagement, value chain, and double materiality. Okay. In addition to general information, companies must provide details on environmental, social, and governance, the three ESG pillars. Here, the ESRS standards include ESRS from E1 to E5, the environment part, ESRS from S1 to S4, and ESRS G1, the governance. This information helps to understand how a company manages its responsibility towards society and also the environment. But let us look in more detail at the specific topics on which companies must provide data. Under the CSRD, companies must report on three key ESG areas: environmental, social, and governance, as we said. Each category follows a set of European sustainability reporting standards to ensure consistency and also comparability across companies. Regarding the environmental disclosures, companies must provide detailed information on how their activities impact the environment, including climate change, pollution, water and marine resources, biodiversity and ecosystem, and finally, the E5 regards the resource use and the circular economy. For social disclosures, this is the social dimension of ESG, and it focuses on a company's relationship with the employees, communities, and human rights, but also employee well-being, so human rights and community engagement. And finally, the governance disclosures. This part focuses on corporate leadership, ethical business practices, and risk management, but also corporate governance structure, risk management and compliance, and anti-corruption and business ethics. Then we wanted to make, sorry. Okay. We wanted to make a specific focus on Team E5, which is resource use and circular economy, because they're a key aspect of the Corporate Sustainability Reporting Directive. This standard in particular aims to provide transparency on corporate strategies to manage resources, reduce waste, and adopt circular models. But so here, what do companies have to report? First of all, companies must explain how they identify impacts, risks, and opportunities related to resource use, but also which criteria do they adopt to minimize the waste and also optimize the life cycle of materials. Then includes the actions for circular economy, which means initiatives such as reuse, recycling, and designing more sustainable products. But also targets and KPIs. So companies should set clear targets to improve sustainability and also monitor progress. Then the companies must also provide concrete data on raw material used, waste produced, and material recycled. And finally, the financial risks and opportunities. So what is the economic impact of a circular model, and if it can reduce cost and create some sort of value. This is very important because incorporating the circular economy is not only a regulatory requirement, but also a strategic opportunity for companies, because it helps to reduce costs, but also improve efficiency and also respond to growing investor and consumer demand for sustainability. Thank you. I'll leave the floor to Martina, which will present the last part of the presentation. Thank you.
Okay, thank you. So now let's focus on the presentation of sustainability information. They cannot be included in just any document, but they must follow a precise presentation format and presentation guideline. So the ESG information must be integrated into official annual sustainability reporting documents and not in a separate document. Then companies must provide numerical data and monetary amounts from the previous period of action, in order to compare them with the previous year data and highlight progress or critical issues. And finally, data must be coded in XBRL, so the Extensible Business Reporting Language, that is a digital format to facilitate automated analysis. Okay. An important innovation introduced by the CSRD is the requirement for assurance. The initial phase imply that companies will have to obtain limited assurance, similar to a basic audit. Then, in the next phase, over time, the goal is to arrive at a reasonable assurance with more strengthened controls. This verification will ensure that ESG data are not just statements of intent, but reliable and transparent information. And also the assurance certification must come from an accredited independent auditor or certifier. About benefits, we can say that complying with the CSRD is not only an obligation, but an opportunity for companies. The main advantages are the better ESG risk management. In fact, knowing in advance how regulatory and climate change will affect the business could be very helpful for the companies. Then it is attractive for investors, since investors want transparent and sustainable companies. And then the market competitiveness is linked to the good ESG positioning can be a competitive advantage. So the new CSRD rules will have a big impact on companies, and they will have to follow the new regulations and change how they work. So while this may be challenging, it is also a chance to provide to improve transparency and strengthen the market position. One major benefit is better sustainability practices. So companies that include the ESG principles in their business will attract more investors and be better prepared for climate risks and new laws. Being more transparent can be also means also build trust with customers and stakeholders and improve the company's reputation. However, following the CSRD rules will require investments in new skills, data collection, and better reporting systems. For small and medium enterprises in particular, this could be very expensive and require more staff. So a company will also need independent check to confirm their data, adding further cost and complexity. The best approach is to see the CSRD not just as a rule to follow, but companies that start to adopting their early and include sustainability in their strategy will benefit the most in the long run. To summarize, we can say that the CSRD is changing how companies approach sustainability, making the sustainability a key part of their strategy rather than just a side topic. First of all, new standardized reporting requirements ensure that sustainability reports are more useful for stakeholders, and companies must provide clear and comparable ESG data, just like the financial reports. The second, greater transparency bring companies to improve the sustainability efforts by tracking real progress with facts and numbers, and not just only with unclear commitments. And third, sustainability is now integrated into the corporate governance. That means that top executive and boards must take responsibility. ESG factor must be considered in strategic decisions, ensuring ethical, transparent, and risk-aware business practices. So this was the explanation of the CSRD. But on 26th of February 2025, so last week, the European Commission introduced some changes with the omnibus regulation. So the aim is to simplify regulation, reduce the administrative burden for companies, and improve the competitiveness. So which are the main change on the CSRD? The first one is the first one is that fewer companies are obliged to report. So until now, the CSRD applied to about 50,000 companies in Europe. But with this revision, the audience is drastically reduced. Only companies with more than 1,000 employees will be obliged to report on sustainability. So this is a significant change because we are talking about a reduction of the 80% of the companies that were involved. Then a voluntary standard for excluded companies. So the companies that will no longer fall under the reporting obligation will not be left without guidelines. So there will be they can follow a voluntary sustainability reporting model called VSME. And this allows them to communicate their environmental and social impact without being bound by overly strict requirements. Then the Commission will revise the delegated act established with the ESRS with the aim of reducing the number of data points, clarifying provisionings that were unclear, and improving consistency with other pieces of legislation, and also reducing the number of data points. Then one of the most criticized aspects of the CSRD was the enormous amount of data that has to be collected and reported. With this revision, the Commission decided to reduce the number of required indicators and to simplify some provisions that were unclear. Then they removed the switch to reasonable assurance. So the assurance will remain limited, as we said before. And finally, a very important point is that companies will have more time to comply. So for those that have not yet started the CSRD compliance journey, a two years postponement is granted. So this means that large companies and the listed small medium enterprises will be able to take more time to prepare without the risk of sanctions. So lastly, we can say that on one end, these changes reduce the obligation for many companies and reduce the bureaucratic burden and compliance costs. On the other hand, however, there may be less transparency as fewer companies will be obliged to report the sustainability performance. So in summary, we can say that omnibus regulation deeply changed the CSRD, making it less stringent and more focused on large companies. And the question is whether this is a step backwards or an opportunity for companies. However, to ensure the compliance with the CSRD, companies will have to adopt a structured approach following a clear path. And this is an example that companies must follow. And the first step is conduct a gap analysis. So this will help companies to identify areas where they are already compliant and those where improvement is needed. Then it will be crucial to implement appropriate data management systems in order to collect and process and verify the ESG information. Develop a report process is another key element. And last, it will be necessary to start reporting as early as possible in order to test the effectiveness of internal procedures and identify critical issues of each company. So this is the material that we use, and some important reports or link or useful link where you can find more information. And that for now is done. So thank you. And if you have any questions, we are here.
Okay, great. So I think it can be very nice to listen to also a direct experience on the field. So probably can be nice also to listen about what Giovanna can tell us of what has been her experience to implement the CSRD, how it's going, and what changed with the omnibus now, the reshaping that is happening. So that would be nice.
Okay, first of all, thank you everybody for your presentation. So I have some comments in generally speaking, if I can, and then I can tell you about my experience. I would put more highlight on the double materiality assessment because it's a core element to proceed with the reporting, because we need to analyze our business model, we need to understand our impact from both financial and impact side, sustainability side, as you said, because we are not obliged to follow all data points reported in the standards, but those that are relevant for based on our materiality assessment. This is really important. Okay. So
yeah, this is very important. This is a very important point. You're right. And so, not all the, so it's a little bit like it's now with other reporting, no? So in general, so that's where you do the materiality assessment, but now was more focusing on the financial side. And so they were defining with the GRI which indicators to use because they were materially important like this. So, but now with the double materiality, in any case, is extending a bit, not the number of indicators identified.
I didn't get, Francesco.
No,
your
it's
question.
more a question. So with the double materiality at the end, in any case, you have to probably identify more indicators compared to before, no?
Right. You mean with respect to GRI, for example?
Yeah,
Did I get?
yeah.
Okay, yes. And much more complex, as also Martina and Denisa described, because you don't have just to analyze an indicator, a KPI. You have to describe your strategy, your process to calculate the KPI, the process to calculate the KPI. What is next? So this is today, tomorrow, what I see. There is a lot of perspective and strategy in each data point. Okay, it's really complex. And this is my first comment. This comply to CSRD is really a complex path. It's really complex because we need to be aware. And this webinar, for example, is an example of how we can be aware. And then we have to be to organize ourselves as companies to be ready to comply. So governance is a key point. And if I can add a short comment on the standards, the 1 and 2, even if are general, are governance standards because it's how we organize ourselves to comply. Okay, so it is a little bit tricky. It's not only the G1, it's also the 1 and 2 are very important from governance perspective, from a company governance perspective. And I agree with Martina, if I'm not wrong, when you said not only a rule to follow, but something strategic is true, but it's also very I don't know how to say, is huge. It's huge. So many companies are not ready to be ready. Okay, and I mean, because we have to introduce a new way to see our business.
Yeah.
Okay, and I have also
So
some
are you going to do the reporting on
Yes.
based on
are.
corporate sustainability reporting
Yes.
directive or not?
We are continuing to follow this path. We
But
have
you are still obliged based on the new regulation of
the
NIAM.
okay, the directive is not a regulation, so
Yeah,
it's very
then,
complex because as you know, and this was another point I wanted to tell you, is first of all it's draft and is not yet into force, so we need to have the final directive, the text published. Okay, then because of is a directive, is a direction the commission is telling to the national government.
then
So
the
each
country has to
government
apply.
have to recepire, okay, to have the reflection in national law. And we know that the national laws reflecting the CSD have been completed a couple of months ago. So more than 1 year after, 2 years after the directive was into force. So maybe the omnibus will come after the omnibus national law will come after we are obliged for the previous version of directive, because the Italian law, now the decreto, blah, 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 is telling that we are obliged in March 2026. If the new directive omnibus will come in the end of this year, the official one, then each government have to write a law. Maybe will come later. So we have to follow the first obligation, even if the law is changing. Okay?
Yeah.
It's quite complex.
That's very nice.
It's quite complex, and is also interesting because of this approach, directive and so national laws, that the penalties of not comply to the directive is different. In the many cases are administrative ones. In some nations are also penali. Okay, I don't know how to say in English. And you can imagine that the load of these penalties can be very different from state to state. And what I also would highlight is that this directive from political side is very strong because maybe I missed this point, but it's very strong because we are trying as European as Europe to have an influence also outside of European boundaries, because if we are a group with companies outside of Europe, the company outside have to follow the rules of Europe. So we are influencing the international sector world.
Forza Europa.
Okay, so it's really a big challenge, but also a strong,
especially for Chinese. No.
For everybody, for everybody,
for everybody.
For everybody. And about the group, this is very important. I would link also the aspect on financial side. This directive is a financial directive that is modifying, okay, the no financial directive, and now I don't recall the acronym, but is modifying, amending a previous directive for financial reporting only. So we are updating the financial reporting, adding and closing also the sustainability information. This is a concept very important because we are enlarging the meaning of the business. because we are used to consider only financial information as the core. Now we are telling that this core is financial plus ESG impact. Okay, it's very, very strong as indication from the Commission. Okay, and this is why, as you said, the information are enclosed in the financial balance sheet, in the financial report, because is the same. Okay. So these are my main comments on this. The other point you also, Martina, maybe mentioned the collection of this data is very complex, and is key to have all the organization engaged. It's not just we have a team working on sustainability and I have the data. No, because the data are cross organization and everybody has to share and so to participate to this process.